Welcome to Talk Tickers. Imagine waking up tomorrow morning, right? You grab your coffee, you sit down, and you pull up the latest earnings release for one of your biggest portfolio holdings.
Always a stressful way to start the day.
Oh, absolutely. But let's say it's a massive national retail chain. You look at their headline numbers, and their EBITDA has suddenly surged by 20%.
Wow.
Right? On paper, their operating earnings look just absolutely phenomenal. I mean, a 20% jump in a mature retail business.
That should be a career-making quarter for the management team.
Exactly. But then as you dig into the cash flow statement, you realize the company hasn't generated a single extra dollar of actual cash.
Yeah, nothing.
Nothing. They haven't sold one more unit of inventory. Foot traffic is totally flat. And to make matters completely bizarre, your Bloomberg terminal is suddenly flashing red because their lenders are calling to warn of an imminent debt covenant breach.
Which is just a terrifying combination.
It makes no sense. You have higher earnings, literally zero new cash, and an immediate severe credit crisis. And, well, this is the paradoxical, often completely misunderstood reality of lease accounting.
It really is.
Yeah.
And, it's a scenario that plays out on trading desks and in credit committees constantly.
Yeah.
You are staring at a set of financial statements that seem to completely defy basic economic logic, but they are entirely perfectly compliant with the accounting standards.
That's the crazy part. They aren't doing anything illegal.
Not at all. What you're looking at in that scenario is an optical illusion. It's generated by a massive shift in reporting frameworks. And if you, as an analyst or a portfolio manager, if you do not know exactly how to reverse engineer that illusion,
You're going to get burned.
you are going to severely misprice the asset. You're going to miscalculate the credit risk. And honestly, you are going to completely blow up your peer group comparisons.
So if you are managing a portfolio right now, or if you are building out valuation models, this is a mechanism you absolutely cannot afford to misunderstand. Today, we're taking a sledgehammer to all the accounting jargon. In this deep dive, we're covering a critical CFA-aligned financial analysis concept. We're looking at the exact effect of operating versus finance lease classifications on your financial statements and valuation ratios.
Right, the actual nuts and bolts.
Exactly. We are going to look at the actual mechanics of how this works under the hood. You need to understand precisely how the balance sheet swells overnight, how cash flows are literally geographically relocated from one section of the cash flow statement to another.
Mostly to fool algorithmic screeners, let's be honest.
Totally. And how standard setters have essentially forced you to build custom manual adjustment models just to figure out what a company's actual raw operational leverage is.
Yeah, we are approaching this strictly from the perspective of a practitioner today.
No textbook definitions here.
Right. We aren't going to just recite FASB definitions of what a lease is. We're going to walk through the exact mathematical bridges you need to construct when you are analyzing a heavy lessee.
So think about airlines, major retailers, logistics companies.
Or telecom operators with thousands of cell tower leases.
Yeah.
And we will break down the precise traps that catch even seasoned analysts off guard. Particularly the absolute nightmare that occurs when you try to compare a US-based company reporting under GAAP with a European peer reporting under IFRS.
Oh, that jurisdiction trap is brutal. But I want to start by stripping away all the rules and all the pronouncements. Let's just look at the raw economic substance of what we are dealing with here. At its absolute core, what is a lease?
Well, fundamentally, a company needs a physical asset to operate.
Right. Maybe it's a massive automated warehouse in Ohio, or a fleet of 500 delivery trucks.
Or 50 floors in a Manhattan skyscraper.
Yeah.
But they don't want to deploy the massive, punitive upfront capital required to buy that asset outright.
It's just too much cash tied up.
Exactly. So they sign a contract to pay a lesser for the right to use it over a specific multi-year period. Economically speaking, stripping everything else away is just a financing decision.
It is entirely a financing decision, isn't it? But one that has historically masqueraded as an operational expense.
100%. Think about the alternative. If you want that Manhattan skyscraper and you decide to buy it, you go to a syndicate of banks, you take out a massive mortgage, and you put the physical building on your balance sheet as an asset.
And right next to it, you put a colossal, glaring liability representing the debt.
Right. That leverage is visible to everyone. Every screener catches it. But historically, if you lease that exact same building for 30 years with a non-cancelable ironclad contract, the accounting treatment was radically, fundamentally different.
And that historical context is like the skeleton key to understanding why standard setters eventually panicked and changed the rules.
They absolutely panicked.
In the old world, the world before ASC 842 and IFRS 16, we had this incredibly rigid, almost gamified distinction between capital leases and operating leases.
Gamified is the perfect word for it.
Because operating leases were the ultimate magic trick for corporate management teams, weren't they? They were essentially legally sanctioned hidden leverage.
Legally sanctioned hidden leverage, yes. They were completely off-balance sheet financing. Under the old legacy standards, if a lease didn't trigger certain very specific, rigid, bright line tests, it was classified as an operating lease.
Wait, pause right there. Define those bright line tests for a second, because I remember companies used to engineer their contracts specifically to dodge them.
Oh, armies of lawyers were employed just to dodge them. The old rules said a lease had to be capitalized, meaning put on the balance sheet as debt, only if it met one of 4 strict criteria.
Like what?
Well, for example, if the lease term was 75% or more of the asset's useful economic life, or if the present value of the lease payments was 90% or more of the asset's fair market value.
So it's just strict math.
Strict math. So what did clever corporate treasurers do? They structured their leases for exactly 74% of the asset's useful life.
That's hilarious.
Or they engineered the payments. So the present value was exactly 89.9% of the fair value.
That is wild. They were intentionally designing their real estate and equipment contracts not for operational efficiency, but purely to defeat the accounting test.
Entirely for the optics.
And if they successfully dodged those bright lines, what was the prize?
The prize was that neither the asset they were using nor the massive multi-million-dollar future liability they were contractually obligated to pay appeared anywhere on the face of the balance sheet.
Just totally invisible.
Invisible. The only place you saw a trace of it was buried deep in the footnotes as a schedule of future commitments and on the income statement as a simple straight-line rent expense.
So just to put that in perspective for you, you could have a major commercial airline operating a fleet of 500 Boeing 737s.
All right.
And if they structured the leases carefully to hit that 74% threshold, they could keep billions and billions of dollars of contractual, senior, non-cancelable debt completely off the balance sheet.
Which completely distorts the risk profile.
Yeah. If you just ran a standard quantitative screen on that airline, their return on assets would look incredibly high because the denominator, their asset base, was artificially tiny.
Because the planes aren't on there.
Exactly. And their leverage ratios, their debt to equity, would look incredibly safe and conservative because the debt was literally invisible.
And that was the reality for decades. It wasn't just airlines. Retail chains with thousands of stores effectively looked debt-free on paper, despite having billions in non-cancelable rent obligations.
It's crazy to think about now.
But standard setters, both the FASB in the US and the IASB internationally, eventually realized this was fundamentally misleading to investors, creditors, and the public markets as a whole.
Especially post-Enron, right?
Exactly. Post-Enron, there was a massive cultural shift against off-balance sheet financing of any kind. They undertook this multi-year, highly contentious convergence project to end this hidden leverage.
And what was the new philosophy?
The philosophy shifted from those gamified bright line tests to a very simple, undeniable economic premise. An obligation to make non-cancelable lease payments implies a liability that must be recognized.
Makes sense.
And that liability relates to the right to use a certain asset. Therefore, both the asset and the liability belong squarely on the balance sheet.
Which drags us kicking and screaming into the new world. The modern accounting shift dictates that almost all leases must be capitalized.
There are a few tiny exceptions.
Right, like true short-term leases under 12 months, or extremely low-value items like, I don't know, office printers.
Yeah, printers, water coolers, that sort of thing.
But anything material goes on the balance sheet. And this introduced 2 pieces of core vocabulary that every single analyst must know cold: the right of use asset, or ROU asset, and the lease liability.
Crucial terms.
Let's not just give the textbook definition here. Let's build this mechanically. You and I are looking at a brand new 10-year lease contract for a warehouse. Day 1, ink is drying on the paper. What exactly are these numbers representing?
Okay, let's build the model. On day 1, the lease liability is recognized as the present value of all future non-cancelable lease payments.
Okay, present value.
You take the string of cash outflows the company's contractually obligated to make over the next 10 years, and you discount them back to today's dollars. That establishes your liability.
Okay, so that's the debt side.
Simultaneously, to make the accounting equation balance, you create the right of use asset. In the most basic vanilla scenarios, on day one, the ROU asset exactly equals the lease liability.
Plus any initial direct costs or prepaid lease payments they made to secure the lease, right?
Exactly.
So to be crystal clear, the company isn't recording the physical brick-and-mortar warehouse itself on their balance sheet.
No, absolutely not.
They are recording an intangible asset, the right to use that physical space for the duration of the contract.
It is a subtle but vital distinction. You don't own the warehouse, so you can't record the warehouse. You own the right to occupy it.
But the liability side is much more concrete.
It's much more concrete. The standard setters finally aligned the accounting with the economic reality. A 10-year, non-cancelable lease on a facility is economically identical to taking out a 10-year bank loan to buy the space. It is debt, because if you don't pay it, you're in trouble.
If you default on your rent, you face severe financial consequences, asset seizure, potential bankruptcy, just like defaulting on a corporate bond. In bankruptcy proceedings, landlords holding these leases are often very high up in the capital structure.
They get paid before equity, for sure.
By forcing these obligations onto the balance sheet as a recognized lease liability, the accounting finally reflects the true, unvarnished economic leverage of the business.
Okay, I want to zero in on a huge vulnerability in that day one mechanical setup. You mentioned we have to discount those future cash flows to get the present value of the liability.
Yes.
The discount rate chosen by management on day one that must have a massive lasting impact on the perceived leverage of the company.
It is arguably the single most critical and easily manipulated assumption in the entire lease accounting model. I knew it. How do they pick the rate?
The standard says the liability is measured using either the rate implicit in the lease, which is often completely impossible for the lessee to actually determine because they don't know the landlord's underlying costs, or residual value assumptions.
Right. The landlord isn't sharing their internal IRR spreadsheet.
Exactly. So since they can't use that, they must use the company's incremental borrowing rate.
And the incremental borrowing rate is basically what the company estimates they would have to pay a bank to borrow the funds on a collateralized basis over a similar 10-year term.
Right. It's a hypothetical rate.
So I am looking at this from a skeptical analyst's perspective, and the math here is terrifyingly pliable. If a company management team wants to downplay their leverage, all they have to do is aggressively justify a higher incremental borrowing rate to their auditors, right?
You're doing the math perfectly.
Let's put numbers to this. You have a 10-year lease, $1 million a year. That's $10 million in nominal future cash outflows. If your treasurer convinces the auditors your borrowing rate is 4%, the present value of that liability sits around, what, $8.1 million on day one?
Sounds about right.
But what if they aggressively argue for an 8% discount rate? Suddenly, that exact same lease, the exact same building, the exact same $10 million in absolute cash obligations is recorded as a liability of just $6.7 million.
Yep.
By tweaking one unobservable input by 400 basis points, management just vaporized $1.4 million of reported debt from the balance sheet. And the average investor just skimming the headline leverage ratio has absolutely no idea. How is that not manipulated constantly?
It is a massive area of judgment, and therefore a massive area for potential earnings management and balance sheet massaging.
I mean, auditors must push back, right?
Auditors do push back, of course. They require comparable debt issuances or synthetic credit ratings to justify the rate, but the range of acceptable rates can be really wide. And here's the kicker. Both US GAAP and IFRS generally use a set-it-and-forget-it approach for this discount rate.
Wait, what do you mean by that? They don't update it as interest rates change.
Exactly. You establish that discount rate at the inception of the lease, and unless there is a major fundamental modification to the contract, like extending the term or expanding the square footage, you do not update it.
Oh, wow.
So think about what that means right now.
Yeah.
We have had massive fluctuations in global interest rates over the last few years.
Right. Rates went from 0 to 5% in no time.
Analysts are currently looking at balance sheets burdened with lease liabilities that were discounted at historical rates, maybe 2% from the easy money era of 2021, that have absolutely no relation to current market interest rates.
That's a huge blind spot.
If you were trying to calculate the true current fair value of a company's obligations today, You have to be acutely aware of when those leases were signed and what discount rate was permanently attached to them.
So that establishes the balance sheet at inception. You have this massive new asset and this massive new liability dictated by a highly subjective discount rate.
Day one is done.
Now let's trace this forward. We hit the income statement, and this is where we see what I call the great divergence. This is the split between how finance leases and operating leases behave over time, specifically under US GAAP. Let's start with finance leases. Walk me through the mechanics of the income statement.
Okay, so for a finance lease, the accounting completely abandons the concept of rent. Rent no longer exists on the P&L.
It's just gone.
Gone. Instead, the accounting mirrors the ownership of an asset that was financed by debt. The cash payment you make to the landlord every month is economically split into two distinct components on the income statement.
Which are?
First, the right-of-use asset is amortized over the life of the lease, usually on a straight-line basis, creating an amortization or depreciation expense. Second, the lease liability accrues interest, creating an interest expense.
I need an analogy here because amortizing an ROU asset sounds like accounting fiction to a layperson. This behaves exactly like a home mortgage, doesn't it?
The mortgage analogy is the most accurate way to understand it, honestly. Think about the first few years of a 30-year mortgage on a house.
Okay.
Your monthly cash payment to the bank is exactly the same every single month. But in year one, what is actually happening behind the scenes?
Well, in year one of a mortgage, almost your entire payment is just being swallowed by the interest on that massive initial principal balance. You are barely making a dent in the actual debt.
Exactly. Your principal balance, the lease liability, is at its absolute highest on day one. Therefore, the interest calculated on that massive balance is at its absolute highest in the first year.
Right.
As you slowly pay down the liability over the years, the interest portion of your expense declines. But remember, your amortization of the asset is a flat, straight line amount every year.
Oh, I see where this is going.
So if you add a flat amortization expense to a declining interest expense, your total lease expense recognized on the income statement is heavily front-loaded. You recognize significantly higher total expenses in the early years of the lease and lower total expenses in the later years.
I have to push back hard on this because this specific mechanic causes more confusion in valuation modeling than almost anything else.
It really does.
If my cash going out the door, the actual wire transfer to the landlord is exactly $10,000 every single month, how can standard setters possibly justify making the company vastly less profitable in year one than in year 5?
Because of the matching principle.
But the physical utility of the building hasn't changed. I'm paying the exact same cash. Why does a finance lease artificially depress my net income early on?
It feels counterintuitive, but it all comes down to the mathematical reality of an interest-bearing liability. The cash payment of $10,000 is not your expense. Cash flow is not expense.
Right. Cash versus accrual accounting.
Your expense is the cost of consuming the asset, the depreciation, plus the cost of financing the debt smattered. The interest. In year one, a huge portion of that $10,000 cash payment is just covering the high interest on your massive day one liability. Only a tiny fraction goes to paying down the principal.
No.
But on the income statement, you are forced to take the full straight-line depreciation charge plus that massive year one interest charge. The sum of those two non-cash expenses will actually mathematically exceed the $10,000 of cash you paid.
Wow. So because you chose to finance the right to use the building rather than just expensing it as you go, you are heavily penalizing your earlier earnings. You are artificially depressing net income purely because of the amortization schedule of a liability, completely disconnected from the actual operational economics of the building.
Precisely. You are front-loading the pain, but now compare that to an operating lease under US GAAP.
Right, because US GAAP has two models.
When the FASB wrote the new rules, they faced massive pushback from US corporations who hated this front-loading effect. So the FASB compromised.
Of course they did.
They created a dual model. They said, okay, we will force you to put the operating lease liability on the balance sheet for transparency, but we will not disrupt the income statement.
So what happens?
For an operating lease under US GAAP, a company calculates a single blended lease cost, which is recognized as a simple straight-line charge over the entire lease term.
So if I have an operating lease under US GAAP, my total expense on the income statement is just a flat line. $10,000 a month in cash out the door, exactly $10,000 a month in operating expense hitting the P&L.
Exactly.
There is no front loading. There is no separate interest line item. There is no separate depreciation line item. It just acts like old school rent.
Correct. And to make the math work on the balance sheet, the right-of-use asset for an operating lease is essentially amortized in a plug fashion.
Plug fashion.
The accountants forcefully shape the amortization curve of the asset to ensure that when combined with the interest on the liability, the total lease expense remains perfectly straight line, perfectly matching the cash payments.
Okay, this brings us to the cash flow statement, which honestly might be the most heavily manipulated and misunderstood document of the three when it comes to leases.
Oh, absolutely.
We need to follow the cash flow geography. Where does the money actually go when it leaves the company's bank account?
Well, for operating leases under US GAAP, the geography is very straightforward and intuitive. Because the expense is considered a single normal operating cost, the entire cash payment to the landlord remains right where you would expect it, in cash flow from operations, or CFO.
It's an operating cash outflow.
Right.
But for finance leases, this is where the teleportation happens. The geography shifts completely.
It shifts dramatically.
Yeah.
Because a finance lease forces you to mathematically separate the payment into interest and principal repayment, the cash flow statement must reflect that split.
Okay.
The interest portion might still sit in operating cash flows, depending on certain accounting policy elections. But the principal repayment portion is entirely evicted from operating cash flows. It is moved down the statement into cash flow from financing or CFF.
Stop right there, because this is the trick that catches algorithmic traders and lazy analysts every single day.
Every day.
By simply classifying a lease as a finance lease instead of an operating lease, a company's cash flow from operations automatically, mechanically looks higher.
Okay.
They haven't generated a single extra penny of actual operational cash from selling their products, but because the principal repayment of the lease was teleported down into the financing section, their CFO metric artificially inflates.
It is a massive systemic trap for anyone who just runs quantitative screens for CFO growth without digging into the footnotes. You must look at the total cash outflow for leases across all sections of the statement to see the real picture.
So if I'm comparing two identical companies.
Right. If you're comparing two identical companies in the same industry where one uses operating leases and the other uses finance leases, the finance lease company will always report structurally higher operating cash flows.
Not because they're a better business.
Purely due to the mandated geography of the cash flow statement.
Okay, let's transition into the practical application. This is where the academic theory hits the trading floor and the credit committees. I want to go back to the scenario we opened the deep dive with, the EBITDA optical illusion.
The 20% surge.
Exactly. We had a company whose EBITDA surged by 20% overnight without any actual economic improvement. Let's break this down to its absolute core. Why does EBITDA fundamentally break under finance lease accounting?
To understand why it shatters, you just have to look at the acronym itself. Earnings before interest, taxes, depreciation, and amortization.
Right.
Under the old historical operating lease model, rent was just a standard operating expense. It was deducted high up on the P&L before you ever arrived at your EBITDA subtotal. If you paid $10 million a year in rent, your EBITDA was $10 million lower. Pretty simple.
But under finance lease accounting, as we established, that rent expense ceases to exist in the operating layer.
Exactly. It is entirely stripped out of operating costs and replaced by two new components: depreciation of the right-of-use asset and interest expense on the lease liability.
And where do depreciation and interest sit on the income statement?
They sit below the EBITDA line.
Wow.
Because you have removed a massive, very real operating cash expense from the top of the P&L and replaced it with two non-cash expenses that are explicitly, by definition, excluded from EBITDA. Your reported EBITDA artificially inflates by the exact dollar-for-dollar amount of your lease payments.
Let's put a human face on this with a concrete scenario. Imagine you and I are on a credit committee at a major commercial bank.
Okay, I'm with you.
We are looking at a national retail chain, let's call them Retail Corp. They have 500 leased storefronts in prime, expensive shopping malls across the country. Rent is arguably their single largest operating expense outside of employee payroll.
Oh, without a doubt.
If the accounting standard changes overnight, or if they restructure to finance leases, their entire massive rent expense is instantly wiped out of their operating layer. It metamorphoses into depreciation and interest. Retail Corp's EBITDA is going to look absolutely monstrous compared to their historical numbers from just 12 months ago.
On paper, they will look like a fundamentally transformed, wildly profitable cash machine.
Right.
But then across the desk, you have a loan application from a boutique management consulting firm. They operate out of one modest office building that they bought with cash 20 years ago.
They own it free and clear.
Exactly. They have no leases. The accounting standard change has zero impact on them. If you are a junior analyst running a lazy screen on EV to EBITDA multiples, and you don't manually adjust for this accounting treatment, retail core is going to look incredibly cheap.
And their margin profile is going to look vastly superior to the consulting firm.
But the underlying raw unit economics, the actual cash generated by selling a t-shirt versus the actual cash wired to the mall landlord, haven't changed by a single cent.
This illusion doesn't just stop at EBITDA, it ripples and tears through the entire suite of key financial ratios. Let's not just list these out. Let's actually walk through our credit committee meeting for Retail Core.
Let's do it.
We are looking at their dashboard of ratios the day after they capitalize all these leases. We've established the balance sheet has ballooned with new assets and liabilities, and EBITDA has artificially inflated. Let's start with leverage. We look at the debt-to-equity ratio. What do we see?
You see a catastrophic spike upward.
Really?
When Retail Core capitalized those 500 mall leases, they added a massive new liability to the balance sheet, the lease liability. And make no mistake, credit rating agencies and your bank's risk models treat that liability strictly as debt.
But look at the denominator, the equity side.
Their equity remains initially unchanged. In fact, if they are using finance leases, their equity might actually drop slightly in the early years.
Because of that front-loaded expense reducing net income.
Exactly, which flows into lower retained earnings. So the numerator debt explodes while the denominator equity stays flat or shrinks. The debt-to-equity ratio deteriorates immediately and severely.
Okay, next up in the credit file. The current ratio, the classic standard measure of short-term liquidity. Current assets divided by current liabilities. Are they more liquid or less liquid today?
The optics say they were significantly less liquid. The current ratio drops.
Why? Their cash hasn't changed.
Remember the mechanics of the balance sheet addition. That massive right-of-use asset you put on the books is classified as a non-current asset. It's a long-term right to use property over years. You add nothing to your short-term current assets.
Wow.
But the lease liability is a different story. It must be bifurcated. The portion of the lease payments due within the next 12 months is classified as a current liability.
So the numerator stays exactly the same, but you are adding a significant new chunk of debt to the denominator.
The optics of Retail Core's short-term liquidity are suddenly squeezed tight, even though their actual checking account balance hasn't changed a bit.
We flip the page to look at efficiency. Return on assets, or ROA. Net income divided by average total assets.
ROA takes a massive hit. You are dramatically expanding the balance sheet asset base overnight. The denominator is suddenly much larger because of the new ROU asset.
And the numerator?
Net income is either unchanged in the case of an operating lease or actually taking a hit in the early years in the case of a finance lease due to that front-loaded expense curve we discussed.
Right.
A flat or shrinking numerator divided by a massively swollen denominator means the ROA ratio plummets. Retail Core suddenly appears vastly less efficient at generating return from its asset base.
And that dynamic ties directly into asset turnover, doesn't it? Revenue divided by total assets.
Exactly the same mechanic. Asset turnover decreases. Retail Core's revenue is completely untouched by lease accounting. They're selling the exact same volume of t-shirts at the exact same price, but their total reported assets are structurally permanently higher.
So the ratio drops, signaling a decline in asset efficiency, which is, again, purely an accounting artifact.
Completely an artifact.
Finally, the most critical ratio for us as lenders, interest coverage. EBIT divided by interest expense. Can they service their debt?
The interest coverage ratio drops, often significantly, for finance leases. You now have a new, very substantial interest expense line item running through the P&L from the lease liability.
But doesn't their EBIT rise because the rent expense was removed?
It does, but the proportional massive increase in interest expense in the denominator almost always drags the coverage ratio down. Retail Core suddenly looks like it has a much thinner margin of safety to service its debt obligations.
So we sit in this credit committee, we look at the dashboard, and Retail Core looks more highly levered, less liquid in the short term, fundamentally less efficient with its assets, and closer to defaulting on its interest payments than they were 24 hours ago.
On paper, yes.
And yet, operationally, they're unlocking the doors and selling t-shirts the exact same way they were yesterday. So how do actual practitioners deal with this? Because I know for a fact that credit analysts at banks and rating agencies like Moody's aren't fooled by these accounting changes. They don't just blindly input the GAAP numbers. They build what we call the bridge.
They absolutely build the bridge. The sophisticated professionals have always known about this hidden leverage.
They weren't born yesterday.
Exactly. Even decades before the accounting rules finally changed to force it onto the balance sheet, analysts were making manual adjustments. Historically, before ASC 842, analysts used a blunt heuristic.
The 8x multiple, right.
Yeah. They would dig into the footnotes, find the disclosure for future rent expense, and multiply the annual rent by a factor usually 6x or 8x, depending on the industry and prevailing interest rates, to estimate the hidden debt. They would then manually slap that estimated debt onto the balance sheet to calculate an adjusted, realistic leverage ratio.
But now we are in the modern era. The leases are fully capitalized on the balance sheet under the new rules. So why are analysts still forced to build a standardized bridge? Why can't we just trust the reported numbers?
Well, because, as we discussed with the discount rates, the accounting measurement of that liability might be heavily manipulated by management and might not reflect current economic reality.
Right.
But more importantly, analysts desperately need comparability across time and across peers. They need a normalized cash basis EBITDA for peer benchmarking and for applying EV to EBITDA valuation multiples. What you will see as sophisticated analysts do today is essentially reverse engineer the entire finance lease accounting framework.
Okay, walk me through the exact steps of that reverse engineering. If I am looking at a bloated post-ASC 842 EBITDA, how do I build the bridge back to reality?
It is a three-step process. Step 1, you take the reported artificially inflated EBITDA number.
Okay, got it.
Step 2, you find the new depreciation expense related to the ROU asset and the interest expense related to the lease liability, and you make sure they are thoroughly stripped out of any operational metrics.
Pulling them out.
Step 3, and this is the most important part, you go to the cash flow statement, or the footnotes, you find the actual literal cash lease payments made to the landlord during the period, and you manually deduct that cash amount from the inflated EBITDA.
So what are we actually accomplishing with that math? We are unwinding the accounting fiction. We are driving the metric back to a pre-accounting change, hard cash basis reality.
Exactly.
We want to see the actual raw operational cash flow available to the business after the contractual, non-cancelable rent has been paid. Because if I am valuing this business and I apply a 10x multiple to an EBITDA that artificially ignores a massive cash rent expense, I am overvaluing the company by the present value of all its future lease payments.
It's a catastrophic valuation error that will blow up a portfolio.
It is catastrophic for equity valuation, but it has intense, immediate, real-world consequences for debt. And this transitions us from theory to corporate survival. Let's discuss covenant risks and the behavioral changes these accounting rules triggered in corporate boardrooms.
This is where things got really tense in the corporate world.
Right. Let's go back to retail corp. Loan covenants in their credit agreements are strictly defined, often based on ratios like net debt to EBITDA or fixed charge coverage.
Yep.
If our bank treats this newly recognized lease liability as strict financial debt within the legal definition of the covenant, Retail Core could accidentally breach a net debt covenant the very morning the accounting standard goes live, without losing a single customer or changing a single operational dynamic.
It was a massive systemic panic. When ASC 842 and IFRS 16 were rolling out, corporate treasurers were having daily meltdowns.
I can imagine.
If their legacy credit agreements were written with language that automatically adopted any future changes in GAAP, their leverage ratios would instantly spike overnight. This would trigger technical defaults, it would trigger higher interest rate ratchets embedded in the debt, or in the worst case scenario, it would trigger demands for immediate, accelerated repayment of the principal.
So how did companies manage this existential threat? I know they didn't all just default en masse. They had to go back to the table and renegotiate with their lenders, usually implementing what lawyers call frozen gap clauses.
Yes.
I have to push back on this practice, though. Isn't a frozen gap clause essentially just an agreement to lie to the public? You're keeping two sets of books, one SEC-compliant reality for the shareholders and a completely different fictional reality for your lenders.
It is absolutely a dual reality system, but from a legal standpoint, it is a necessary mechanism to prevent accounting changes from destroying healthy businesses.
How does the clause actually work?
A frozen gap clause essentially states that for the explicit purpose of testing the financial covenants in the loan document, the accounting rules are frozen in time, usually reverting to the rules that existed when the loan was originally originated.
So they just pretend the new rules don't exist.
The banks and the companies legally agree to calculate EBITDA and debt using the old legacy operating lease methodology. They completely ignore the new ROU assets and lease liabilities that are sitting right there on the actual reported SEC balance sheet.
It is fascinating that the lenders, the people who care most about leverage, agree to just look the other way because they know the new accounting metric doesn't reflect the historical risk profile they initially underwrote.
It's pragmatic.
But beyond just negotiating with lawyers and creating two sets of books, this accounting change actually altered physical, boots-on-the-ground business strategies. The optics of the balance sheet became so punitive that companies fundamentally changed how they manage real estate.
Absolutely. Think about the incentive structure. Because the lease liability recognized on the balance sheet is the present value of future payments, the easiest, fastest way to keep that recognized liability small is to simply sign shorter leases.
Of course, lower present value.
Exactly. Instead of locking in a highly favorable, predictable 10-year rate on a strategic warehouse, a corporate real estate team might intentionally sign a 3-year lease just to keep the recognized debt lower on the balance sheet. They are actively accepting the operational risk of a massive rent hike at renewal purely to massage the accounting optics today.
We saw exactly this behavior during the rise of co-working spaces, didn't we?
Yes, WeWork and all the others.
Companies were flocking to flexible, short-term lease providers, not just for the ping pong tables and the cold brew, but because a month-to-month commitment meant practically zero lease liability hitting their balance sheet.
It was a huge selling point.
They were trading long-term operational stability for short-term accounting cosmetics. They also started heavily utilizing subleases, right?
Yes. Subleasing excess space became a critical strategy because the sublease income can sometimes be used to offset the lease costs and help manage the ratios, or at least provide cash to service the new visible debt. It is a classic textbook example of accounting rules ceasing to merely reflect underlying business behavior and instead actively driving and distorting it.
Okay, we need to pivot to the exam context and cross-topic connections. If you are analyzing global companies, or if you are a candidate sitting for the CFA exams, there is a massive gaping trap here that will destroy your models if you aren't paying attention.
The biggest trap of them all.
It is the fundamental, unresolved difference between US GAAP and IFRS.
This is undoubtedly the most dangerous trap in the entire curriculum regarding leases. We've mentioned the grand convergence project between the FASB in the US and the IASB internationally.
Right, they tried to get on the same page.
Well, they successfully converged on the balance sheet. Everyone finally agreed that leases must be capitalized as assets and liabilities. But when it came to the income statement, the convergence spectacularly failed. They fundamentally disagreed on how to reflect the expenses.
IFRS took a hardline, purist approach. Under IFRS 16, there is no distinction between an operating lease and a finance lease for a lessee. They abolished the dual model. All capitalized leases are treated strictly as finance leases, period. No exceptions.
Which means under IFRS, every single lease a company signs generates a front-loaded interest and depreciation expense. And more importantly, every single lease strips the cash rent payment out of operating expenses.
So they permanently and artificially inflate EBITDA.
Inflating EBITDA and inflating cash flow from operations across the board for every European or international company using the standard.
But US GAAP, as we discussed earlier, blinked. They faced corporate lobbying and allowed the distinction to remain. For U.S. companies, an operating lease stays an operating lease on the income statement. The expense remains a single straight-line number. It remains an operating cost. It effectively reduces EBITDA, and the cash outflow stays in cash flow from operations.
Therefore, consider the nightmare scenario for a global analyst. You are comparing a U.S. retailer reporting under GAAP to a European retailer reporting under IFRS.
Okay, side-by-side comparison.
You cannot, under any circumstances, take their reported EBITDAs at face value. You cannot take their operating cash flows at face value. Even if they have the exact same number of stores, paying the exact same rent, selling the exact same volume of goods, the European company's EBITDA will look structurally massively higher.
And their CFO will look structurally higher purely due to the jurisdiction of the accounting standard.
Purely because of the jurisdiction.
If you run a simple, automated, quantitative screen without manually adjusting for this gap versus IFRS divergence, your data is garbage. It is worse than useless. It is actively misleading.
Completely misleading.
The European company will look like a cash-generating machine with vastly superior operating margins, when in reality, they might have the exact same or even worse unit economics as the American company. You have to put the work in.
You have to build the bridge.
You have to manually adjust the U.S. company's models to behave like a finance lease, or you have to adjust the IFRS company's models back to a cash basis rent expense just to achieve basic peer parity.
Let's elevate this and connect this accounting reality to a broader classic analytical framework. Let's integrate this entire discussion into the DuPont analysis.
Oh, I love the DuPont breakdown.
The DuPont framework is the gold standard for breaking down return on equity, or ROE, into its three core operational pillars: net profit margin, asset turnover, and the equity multiplier, which is the measure of leverage.
This is a phenomenal exercise. Walk us through exactly what happens to those three distinct pillars when a company transitions a massive portfolio of operating leases from off-balance sheet to on-balance sheet under a finance lease model. Let's deconstruct the paradox of how ROE behaves.
Let's tackle them one by one. First pillar, net profit margin, net income divided by revenue. Because finance leases front-load the expense, combining a flat, straight-line depreciation with a declining but initially massive interest expense, the total lease expense recognized on the P&L in the early years is significantly higher than the actual cash rent paid.
Right.
This artificially depresses net income. Therefore, the numerator shrinks and the net profit margin drops initially. The company looks less profitable per dollar of sales.
Second pillar, asset turnover. Revenue divided by average total assets. How efficiently are they using their footprint?
Revenue, the numerator, is untouched by the accounting change. But average total assets, the denominator, skyrockets overnight because you just dumped hundreds of millions of dollars of right-of-use assets onto the balance sheet.
Right, the assets just appear.
A flat numerator divided by a massively swollen denominator means asset turnover drops sharply. The company appears wildly inefficient at generating sales from its newly expanded asset base.
Third pillar, the equity multiplier. Average total assets divided by average equity, the leverage component.
Here is where the math swings the other way. The numerator, average total assets, has ballooned, as we just established. Average equity, the denominator, is initially unchanged or slightly reduced over time by the lower net income hitting retained earnings.
So it's getting squeezed.
So you have a massive expanded numerator divided by a flat or shrinking denominator. This means the equity multiplier, the leverage ratio, spikes significantly. The company is mathematically much more highly levered.
So step back and look at the paradox you just built. When you multiply those three pillars together to get the final return on equity figure, the ROE is being violently pulled in opposing directions.
It's a tug of war.
The margin pillar is worse, the efficiency pillar is worse, but the leverage pillar, which acts as an amplifier in the DuPont equation, is drastically higher. For CFA candidates and serious analysts, you cannot just look at the final ROE number, because the ROE might actually stay flat or even rise slightly if the leverage amplifier outweighs the margin and efficiency drops.
You have to look under the hood.
You have to be able to trace exactly how capitalizing a lease flows through the numerator and denominator of every single component, fundamentally altering the risk profile of the return, even if the headline number looks completely stable.
And this logic of manually tracking numbers, moving around the statement specifically, moving the principal repayment of a lease from operating cash flows down into financing cash flows, it mirrors other deeply complex topics in financial reporting. If you master this geographic shift, you can master other areas, like capitalized interest.
Right, let's draw that parallel. When a company is constructing a massive long-term asset, like a utility building a power plant, they're allowed to capitalize the interest on the debt they use to finance the construction.
Exactly. When they capitalize that interest, it doesn't hit the income statement as a period interest expense immediately, which protects their current earnings, right? Instead, it gets added directly to the value of the asset on the balance sheet. But more importantly for our discussion, look at the cash flow statement. That literal cash paid to the bank for interest is legally reclassified. It is moved from an operating cash outflow to an investing cash outflow because the accountants consider it part of the capital expenditure of building the asset.
The mechanical structural parallel there is vital. In both lease accounting and capitalized interest, the accounting standard allows or explicitly requires a company to take a hard cash outflow that would normally depress their operating metrics and magically shift it to a completely different, less scrutinized section of the cash flow statement.
It's sleight of hand.
Whether it's shifting lease principal down to CFF or shifting construction interest over to CFI, the end result is exactly the same. The headline cash flow from operations metric is structurally artificially enhanced. As an analyst, your entire job is essentially playing constant defense against these geographic shifts.
You have to watch the cash flow statement geography like a hawk. You are not just reading the top line or trusting the screeners. You are actively tracking the migration of expenses and cash flows across the boundaries of the statements to ensure the true operational reality of the business hasn't been masked by a clever reclassification.
Which brings us to the final segment of our analysis today. We've covered the historical abuses of the old rules, the mechanical day one reality of the balance sheet, the intense divergence on the income statement, the ripple effects through the credit ratios, and the international traps that will ruin your comps.
We've covered a lot of ground.
We need to distill all of this complexity down to a single point of action. It is time for the one question. When you, as a senior analyst or a portfolio manager, are sitting down to look at a company with significant real estate footprints or heavy equipment usage, what is the single most important question you must ask about their financials before you input a single number into your valuation model?
The question you must always unconditionally ask is this: am I looking at a pre-IFRS 16 reported EBITDA, a post-IFRS 16 reported EBITDA, or a fully adjusted, manually calculated cash basis EBITDA?
And why is that specific distinction the single most critical filter for your analysis?
Because if you apply a historical legacy valuation multiple to a modern post-accounting change EBITDA that has artificially stripped out rent, you will dramatically, catastrophically overpay for the asset. You will be fundamentally confusing a fabricated accounting uplift with genuine operational economic value creation.
That is the trap in one sentence. Let's quickly recap the three main pillars of this framework so you can take this straight to your terminal. Number one, the balance sheet is fundamentally heavier. Capitalizing leases balloons the asset base with intangible rights and creates massive new debt liabilities, meaning your leverage ratios deteriorate immediately and your asset turnover drops.
Number two, the EBITDA optical illusion. Because cash rent expense is essentially transformed into non-cash depreciation and interest for finance leases, reported EBITDA artificially inflates, and the cash flow geography shifts operating outflows into financing outflows, making CFO look stronger. You have to build the bridge back to cash reality.
And number three, the US GAAP versus IFRS trap. IFRS forces all leases into the finance model, inflating earnings metrics globally, while US GAAP retains the straight-line operating model for the income statement. If you do not manually adjust for this jurisdictional difference, your cross-border peer comparables will break entirely.
And it's always a quick reminder that this discussion is for educational purposes only and does not constitute investment, legal, or accounting advice.
Here is my final provocative thought for you to chew on as you go back to your models. If unelected standard setters in Norwalk or London can wipe out billions of dollars in operating cash flows overnight, or inflate global EBITDA by double digits simply by changing the definition of a single word in a textbook, are we actually analyzing the economic reality of companies anymore? Or have we just been reduced to analyzing the psychology of accountants? Think about that next time you screen a portfolio for CFO growth. Apply this framework to the next set of financials you pull. Look deep into the footnotes, find the lease commitments, strip out the noise, and calculate the real leverage yourself. Thank you for tuning in to Talk Tickers. Remember, the underlying economics don't lie, but the standard setters certainly change the language they speak. See you next time.